Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading economic and financial developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And we begin in Europe. The political fallout has already started. Germany and France sharply criticized the European Union's newly minted trade deal with the United States on Monday, warning that it will inflict lasting harm on the bloc's economy, even as it averted a full-blown transatlantic trade war. German Chancellor Friedrich Merz said the agreement, which imposes a 15% tariff on most EU exports to the United States, would cause, quote, considerable damage, end quote, to Europe's largest economy and ripple through global trade. Quote, not only will there be a higher inflation rate, but it will also affect transatlantic trade overall, end quote, he said. Merz added that while the outcome was, quote, the best result achievable in a given situation, end quote, the German economy would pay a heavy price. The deal struck Sunday between US President Donald Trump and European Commission President Ursula von der Leyen reduced the threatened 30% tariffs, but left most of the bloc's key exports, including cars, pharmaceuticals, and semiconductors, exposed. We covered the details in yesterday's video. Market reaction was swift. The euro slid more than 1% against the dollar, on course for its second biggest fall this year. Stocks across major indexes fell too. French leaders delivered some of the harshest criticism. Prime Minister François Bayrou called the agreement a, quote, dark day, end quote, and accused Brussels of having, quote, resigned itself into submission, end quote. One former French Prime Minister branded the accord, quote, an admission of weakness, end quote, arguing that it demonstrated the EU's failure to leverage its single market to protect European sovereignty and prosperity. Of course, as we've discussed in the weeks leading up to this agreement, the Europeans were not exactly in the strongest position. Having a massive trade surplus with the United States, it needed that large market to sell to. The initial public backlash has been rather strong, with many publics dissatisfied that their leadership was unable to secure a better deal. National leaders are likely siding with this public sentiment, criticizing the EU publicly, while likely privately admitting that the EU only had so many options. Industry voices echoed the political discontent. The head of the Federation of German Industries, BDI, blamed the EU's, quote, poor competitiveness, end quote, for the weak negotiating outcome, urging Brussels to strengthen its bargaining power ahead of future disputes. Quote, when there are the next rounds and the next conflicts, I would like an EU that is stronger and that can also play to its strengths, end quote, he said. While von der Leyen hailed the agreement as the, quote, biggest trade deal ever, end quote, covering nearly half of global GDP, critics warned that it entrenched an imbalance in favor of Washington. The chair of the European Parliament's Trade Committee described the pact as, quote, asymmetry set in stone, end quote, and demanded assurances that EU regulatory sovereignty, particularly on digital services and carbon pricing, had not been compromised. Despite the backlash, some leaders urged pragmatism. The Irish Deputy Prime Minister said the accord avoided a trade war that, quote, was in no one's interest, end quote, describing it as a framework for deeper cooperation. But with the euro tumbling, markets rattled, and political divisions widening, the EU now faces the challenge of defending its economic interests while managing an uneasy truce with Washington. And speaking of Washington, let's cross the Atlantic now to North America. Wall Street is increasingly taking command of Bitcoin's price discovery, shifting the cryptocurrency's center of gravity from offshore exchanges to the heart of the US financial system. What began as a decentralized experiment is now being recast within the frameworks of traditional finance through a booming market and exchange-listed options tied to Bitcoin exchange-traded funds, ETFs. At the forefront is BlackRock's iShares Bitcoin Trust, IBIT, or IBIT, which has rapidly grown into the largest Bitcoin ETF with $86 billion in assets. Its rise has sparked an unprecedented surge in options trading, with open interest tripling this year to about $34 billion. Daily volumes now average $4 billion, surpassing major funds in credit and emerging markets, and trailing only the most liquid equity and gold ETFs. IBIT's dominance underscores a broader transformation. Crypto risk is increasingly being priced through regulated US venues rather than offshore leverage-driven platforms. Nearly half of spot Bitcoin volumes now flow through US-listed ETFs, while the share of Bitcoin dollar trades during US hours has climbed to 57.3%, up from 41.4% in 2021. For institutions once sidelined by regulatory uncertainty, IBIT provides a compliant, liquid gateway. The shift has also also altered trading behavior. Analysts note a growing use of puts for hedging rather than speculative calls, signaling the arrival of institutional risk management strategies that mirror equity and bond markets. Yet IBIT's meteoric rise is colliding with structural limits. The regulatory cap of 25,000 contracts constrains the size of systematic strategies, prompting calls for the SEC to raise the threshold. Nasdaq has proposed a tenfold increase, with a decision due by September. Meanwhile, Coinbase's $2.9 billion acquisition of Deribit in May is seen as a step toward bridging the gap between IBIT's regulated market and offshore venues. Integration efforts could eventually allow unified collateral systems and greater arbitrage opportunities, tightening the link between the two ecosystems. For now, IBIT has cemented itself as Wall Street's primary conduit into crypto, accelerating Bitcoin's absorption into mainstream financial infrastructure. As the CEO of KeyRock put it, quote, "Eventually all assets will be digital, and what we now call crypto will just be another part of the financial system, priced and risk managed like everything else." End quote. Next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button, and if you want to continue to be on top of the most up-to-date analysis on the biggest developments in the world's most important markets, consider subscribing to Market Update. And finally for today, we move to Asia. Taiwan Semiconductor Manufacturing Co., TSMC, the world's largest contract chip maker, raised its 2025 revenue growth forecast to about 30% in US dollar terms, up from its previous mid-20% estimate. The move shows the surging global demand for AI infrastructure and reinforces confidence in a prolonged investment cycle led by technology giants like Nvidia, Meta, and Google. The upgraded outlook came as TSMC reported a 61% jump in net income for the June quarter to $13.5 billion, beating analyst expectations. Revenue surged 39% year-on-year to a new record, driven by strong orders for high-performance computing (HPC) chips used in AI data centers. HPC now accounts for 60% of TSMC's total revenue, a significant shift from its earlier reliance on smartphone chips. CEO C.C. Wei emphasized that AI demand remains robust, with no signs of a slowdown from major customers. However, he cautioned that potential US tariffs and an appreciating Taiwanese dollar could weigh on future performance. TSMC estimated that each 1% appreciation in the Taiwan dollar reduces revenue by the same percentage. The currency has gained more than 11% this year, the best performer in Asia. Despite these macroeconomic challenges, TSMC remains confident in maintaining long-term profitability, with CFO Weldon Huang reaffirming a gross margin target of 53% or higher. However, margins are expected to dip in the current quarter due to unfavorable foreign exchange and rising costs from overseas operations. TSMC is also accelerating its global expansion. Wei announced that construction of its second and third fabs in Arizona has been expedited by several quarters to meet rising demand from US-based clients. The company plans to invest between $38 billion and $42 billion in 2025 to upgrade and expand capacity as part of its broader $100 billion commitment to build out advanced manufacturing hubs in the United States, Japan, Germany, and Taiwan. Around 30% of its future 2-nanometer and beyond chip capacity will be based in Arizona. Meanwhile, recent US export control relief allowing Nvidia and AMD to resume shipments of downgraded AI chips to China is seen as a positive industry development. Wei noted that this could benefit TSMC indirectly, but said it is too early to revise forecasts. TSMC's bullish forecast comes in stark contrast to the more cautious tone of Dutch chip equipment maker ASML, which recently trimmed its 2026 growth outlook, citing global economic and geopolitical uncertainties. TSMC's consistent outperformance and strategic positioning in the AI supply chain make it a critical barometer for semiconductor sector sentiment. Looking ahead, TSMC expects third quarter revenue of $31.8 to $33 billion, reflecting 38% annual growth. While near-term risks from tariffs and currency fluctuations remain, investors appear reassured by the company's results and AI momentum. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday, and I will see you for another episode tomorrow.